Okay, good afternoon. Welcome to the weekly take on the market. Today is Friday, November 4th. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. Nobody at IBD that I'm aware of is licensed. We don't provide buy, sell, hold recommendations. Our circle of competence is research, education. Okay, so we'll do the market indices. We'll do the industry groups very briefly on the industry groups for a couple of reasons. They haven't really changed much. And there's a lot of stocks I want to cover. And then I have a lot of screenshots that I grabbed because it's been a couple of weeks since I've done this. So the other areas will take up a little bit more of the time. So let's go ahead and pull up the indexes. So you should see a chart of the NASDAQ, and it should be pretty up to date. It is 1:40 my time. So the market was up today. The volume was up. We have not undercut the low, so the potential fall through day is still in play. I think IBD has the market under pressure. I have to admit, I had no idea that the market was up today until the very end. I know it started out really strong, but then Apple, Tesla got hit really hard. There was a lot of weakness in some stocks I'll talk about, like Twilio and Team. So when the market rolled over, and then it did come back near the end of the day. I just thought, oh, it just finished basically flat or down a little bit based on what I was observing. So it was a very strange day. Today epitomized what's been happening in the market for weeks and weeks and months is that the divergence. The money is coming out of the big cap tech stocks, and it's got to go somewhere. I guess it could go to bonds. It probably is getting a little bit of money, but it's going into stocks, energy stocks, material stocks, things like that. So I think I mentioned 2 weeks ago, or maybe I mentioned IBD Live, I want to buy stocks of companies that make stuff that you can drop on your foot, or you can spill on your foot if it's oil or natural gas or something. The companies that make stuff have been underinvested in for a long, long time. And the companies that make, I guess they make stuff in the cloud, so to speak, are just losing their luster. And today was one of the most evident days of that I've seen in a long, long time. So then that's good news, because that's how a market will bottom, is there'll be new leadership and the old leadership will fall by the wayside. It doesn't mean the old leadership has to keep going down. It just won't lead. So if the market goes up 10%, maybe it goes up 8 or 7 or 5, but the other ones will go up 12, 14, 20. They'll go up more because that's where the leadership is. So you're going to get a divergence, or you're getting a divergence, which is actually good news, that maybe we're in some type of bottoming process potentially because of what's happening in the market over the last number of weeks. And today was real evident. IWM, was up 1.3%. VTV, which is the Vanguard Value ETF, was up 1.3%. I actually own this. Look at the divergence in relative strength, especially in the short term versus like the QQQ. So, I mean, the QQQ is stone's throw from making a new low. At one point today, I thought it might be able to make a new low based on the action and some of the stocks I was seeing. So you're within, the low for the Qs is 254, close to 264, but at one point it was 259, 5 points from the low. And 5 points in the QQQs is nothing now. I mean, it was down 9 the other day. I think it was down 9 and change this day and 5 that day. So it's down 14 points in 2 days. So it could easily make a new low in a boom, boom like that. And value, look at the value. I mean, it's not anywhere near making new lows. 15 points, it's 10, 11% from making new lows. So that's the kind of divergence that you want to see. Now, I mean, do you want to buy the Vanguard Value ETF? It's up to you. It's not my favorite. I'd rather buy highly growing individual stocks, but I do have some shorts, and in a bear market, I like to have a counterbalance of something long to give me feedback, and vice versa. In bull markets, I will often probe on the short side a little bit just to get feedback and as a counterbalance. It's not going to be like 100% or 50% long, 50% short, but I might be 60% short, 20% long, or something like that. So this is holding up really, really well. I don't know. I mean, it is what it is. I have to respect the price action in it at this point. The Dow is holding up much better too, because Amgen and stuff like that is holding up pretty good. So the indexes, the NASDAQ, that's not where you want to be. You don't want to be in big cap tech if you're going to be invested. You want to be in other stuff. And if you want to be short, the big cap tech shorts is getting a little long in the tooth. Even for myself, I am still short Tesla. I covered Apple today just because it had gone down so much. I shorted the earnings report on Friday, and it went down, every day this week. So did it undercut that low? Honestly, I covered it, but if it did, I missed by a penny. But I covered it much earlier in the day on the first kind of whoosh down. So, and if it goes back up, I'll try it again until it doesn't work. So I think the money is coming out of these types of stocks. Amazon, look at that. It's just, and Google. I know it's hard to believe, but this is kind of how the stock market works. They're overowned. They were the big leaders for a long, long time, and people just assume that they can never go down because they went up for 10 years. And if you're a student of history like me, I am, they can go up for 10 years and then go sideways to down for 20 or 15 for Microsoft. How about Cisco? Sideways to down since 1999. What's that, 23 years? And I know it might sound crazy, but if we were to move this part of the chart of Apple to here, it could look like this for a long, long time. I don't know. I'm saying it's possible. Is it likely? I don't know, but it definitely is possible. You have to build that into your model, and for all the other stocks as well. So that area looks way overowned and needs a break. Okay, so let's. So speaking of being a student of history, this bear market, I can't wait to read the history books on it. Whether it's a year or 5 years from now, I just know that it's going to sound like it was so easy that the bear market happened, and there were so many signs. I remember in '99 and 2000 just being flustered by the market because of all the signs of euphoria and speculation, and I just knew that a bear market was coming. I just didn't know when, and I felt the same way here. Going after the COVID year, where everybody's running around who made 100% in the market. I just knew that it just was unlikely that it was going to continue like that, especially after we've had a 10-year window of such, good performance. And then you stack on a year where you can make 100% in an IRA. And other guys out there, on Twitter make 300-400% in margin accounts. So this was one of the signs. Somebody tweeted that the bear market will be over when they stop running the QQQ commercials for the NCAA, where the girl can coach the basketball team or the guy can coach the football team, just a regular person, because they're what are they, something of innovation. They invest in QQQ, therefore they're really smart and can do anything. And these are signs of that it's run for too long. So you can see the QQQ, they weren't down there at 100 telling you about that, right? It was up here at 300 and change. And the hard part about these signs is that when they occur, they never signal the top. That's why they always say that nobody rings a bell at the top. They ring about 100 bells at the top. And that's why I'll be excited to read the book, because you'll see, they'll tell you all the bells that went off. You say, oh, I remember that. But if you tried to fight it here, you got run over, right? And if you stayed out, it's very frustrating because everyone else is making money around you and you're not participating because you're on the sidelines because you see these signs. You have to have a real strong discipline and a will to say, this is my style, this is my strategy, I'm going to stick with it. Doesn't mean you have to be completely out, but you might be, lightly invested versus, pedal to the metal and something like this. The volatility has been pretty good this year. The number of months the S&P up are down 7.5%, 5 this year in 2022. 1937 was 5. 1933 was 9. Almost every month was up or down at least 7.5%. So it's a very volatile year in the S&P. This is interesting. Estimated performance. So I read the article by the Financial Times. I don't know how they got this number or what they just said estimated performance of retail traders, but they have them 44% off their high as a group. You can see the COVID low down here, the rally, and not quite undercutting that, but not a great year for the average retail trader. So if you're hanging in there, if you're down 5-10% this year, you're outperforming most retail traders, according to Financial Times. If you're up a little bit, you're knocking it out of the park versus them. If you're not having a great year, then you need to go back and figure out why. Where did you kind of stumble? I would say most likely it's sell rules. Having sell rules. If you didn't have a sell rule, some of that, like the ARC ETF, it's down so much. It's just because they don't have sell rules. So they ride Roku down 80%. They ride Zoom down 80%. They ride Twilio down 70%. The only way you can do that is not have a sell rule. Twilio didn't open down 70%. In fact, it went down pretty uniform until the very end. Till today, and we'll pull that up. So I think, in my career, there's been like 4 years where sell rules have just really saved my bacon. Like I was just like, wow, it's good to have sell rules. And the other 21 years, they've hurt me, so to speak, as a general rule, because you sell something, it has a little wiggle, you sell it, and then it goes higher. But they really, really save your bacon. In a 25-year trading career, if you don't have sell rules, I don't care how much you make, you're going to give it all back and then some if you don't have sell rules. If you're buying individual stocks, you want to buy mutual funds or ETFs and things like that, well diversified, a different story. Not my game. So that might not apply here, but I know for sure it applies to individual stocks. This is not, for Twilio or Roku or Funko, FNKO to do what they did. You shouldn't be surprised. I'm not saying I knew that these ones were going to do that, but I knew that this would happen at the end of the cycle because it always happens. Listen to Mark Minervini talk about his rules and Bill talk about the 72%. average. When a leader peaks, the average decline is 72%. That's the average. That means some of them, go down 40. That means some of them go down 95 or 85 to create that average. So you have to have sell rules. I know they're no fun in a bull market, and in most of the time the market goes up, but you have to have sell rules for individual stocks. IPOs, it's been a real tough year. All those companies that went public probably shouldn't have gone public in the last 2 years. Money was free, 0% interest rate environment. TINA, there is no alternative. So, even the mediocre ideas got money. If you can borrow money at 0% and you got a mediocre company, no problem. I can make 5%. That's a huge return, borrowing at 0 and making 5, especially if you could scale it. Now that interest rates are 4, you want to borrow 4 and invest in a mediocre company and try to make 5? No, thanks. They don't want to do that. And so most of these IPOs are below their IPO price. The good news is some of them will survive. A lot of them will go away. Some of them will survive. And which ones will survive? The new leaders, the best ones. And then you'll get a whole new batch of new names in the next cycle. When, I don't know how many IPOs there have been this year. I would guess very few. But eventually there'll be another cycle IPOs. And I imagine the investment bankers will be more diligent with the types of companies they take public. Here is the MSCI China index. So if you've been invested, if you bought it 30 years ago, you put $1 in, you've got $1 left. So stocks for the long run, true, invest for the long run, but have sell rules again. And that's the way to make money in individual stocks. Now, let's say you were dollar cost averaging into a mutual fund in this environment. I think you'd probably still be up, because actually a lot of the time was spent below the 0 line, especially 98, 2000, 02, 04. You would have really been accumulating a lot of stock at that point. And the peaks are fleeting. They don't last long. So you don't get a chance to dollar cost average at super high prices for a long, long time. So that's the first thing I think of when I see this. And secondly, I think of what a opportunity we have in America, and the best companies, and they're on the U.S. exchanges. It's really the best place to be an investor. I know we have a lot of international clients in Marcus Smith, and when I talk to them, I always ask them why do they take Marcus Smith? Why do they invest in the US market? Because we don't have an international database. And almost always the answer is the breadth of quality companies. The possibilities on our exchanges are so much greater than they are, say, the FTSE in London, or the Bourse in Europe, or the French, or the Singapore Stock Exchange. And I know that for experience, because I had an international portfolio at O'Neill a few years ago, and I had to invest in international stocks. And I'd buy stocks in Japan or Singapore or France or Germany. It's just a lot harder. There just wasn't anything to get excited about versus on the U.S. exchange, especially in that time frame, like 2014, 2015, 2016, when you have all these companies you want to buy in the U.S. and it's very hard to find that same type of quality overseas. The size of the big cap tech stocks, they're just overowned. I just think this is a trend that's going to continue. They went from 8% 2015 to 24% late 2020. And although it is off the highs a little bit, I don't think that. I think this is closer to the beginning than the end. And so you're just going to get a gradual bleed here is the way I see it. I might change my mind 6 months, 9 months, a year from now, but the market is confirming my feelings on this lately. Apple, look at the action in Apple, Tesla, Amazon. There's just not, there's just no leadership there anymore. And they're just so big. And there's nobody, you know, if you haven't invested in these companies already, I mean, who's the next buyer, right? The Swiss National Bank has, last I looked, I think 5% of their balance sheet is in Apple. Warren Buffett has a huge position in Apple. Who's left? Who's left to accumulate Apple? There's just only potential sellers, it seems like to me. Okay, this is a hedge fund performance, and I've hidden the name of the company. I don't want to be a grave dancer. This isn't to signal somebody out that's done poorly, and you know, it's just not my style, because I've been here before. I know how hard it is to make money in the stock market, and I've had some tough years. So you know, I live in a glass house, so to speak. But I use this to emphasize kind of the theme of this is sell rules. You know, so they did great in 16 and 17 and 18 and 19 and 20, because you didn't have to have sell rules in those years. You just bought really good companies, and if you bought them wrong, they came back. That all changed in 2021. And the first clue for them, probably in hindsight, is the poor year, 3.9% versus the S&P. And then you get into this year, in the first quarter, they're down 26%. Alarm bells should be going off. If you're down 26% in a quarter, you need to be getting smaller as fast as possible. The way you get smaller is just you get out. You have to get out. You have to sell, right? And then the next quarter, down 52%. And then you're frozen, right? It's like, what do I do now? It's too late to sell. And then the next quarter, down 17%. So year to date, down 71%. And so you've given back 8, 9, 10 years of performance in 3 quarters by not having sell rules. And, you know, the annualized return since inception is deceiving. If you look at a chart of ARC, or Fidelity did a great study on the Magellan Fund when Peter Lynch ran the Magellan Fund. Most investors lost money in Magellan, even though it was one of the best performing mutual funds. It's hard to believe, but because they pile in at the highs when they're doing the QQQ ads, you know, that's when they're buying QQQ. And so most investors, I would guess, in this fund don't have that same annualized return. They've got the losses, right? Because you can see, if you notice this performance, 17, 18, 19, you start to think, I got to get into this. And then in 2020, you just get confirmation bias. Wow, he's up 96%. And then the following year, you're back to even. That's if you were in, you know, 18 or 19. So sell rules if you're going to invest in individual stocks. All right, so let's pull up the industry groups. And I'm going to guess you guys know the drill with this. Let me rank it. Oil and gas, royalty, energy, solar, telecom. Interesting. Machinery, equipment, transport, retail, wholesale, auto parts, field services, biotech. Very interesting that biotech is holding up so well. Amgen is holding up pretty good. Computer networking, that one's interesting. So it's not as dominated by oil and gas as I would have thought. You know, if you move down the food chain, you've got oil and gas. But I would have guessed that these ones would be a little bit higher up. So that's where mostly the names that I've found. How about look at the recent breakouts? 87 stocks. I thought that was something was wrong there. That there was a bug. I couldn't believe how many stocks are in there. But I bet if we were to sort this by industry, so 1, 2, 3, 4, you can see what's that? About a dozen oil and gas right there. Some biotechs, some food packaged. That's not very good, is it? We don't want food packaging stocks breaking out. Retail supermarkets, trucks. So it's mostly going to be, energy. Okay, let's go to stocks to watch. Let's start with Twilio. Down 34% today. Monthly chart, round trip, goes public, runs up, no sell rules, all gone. Roku goes public, runs up, no sell rules, almost all gone. I mean, let's be honest, most of the people who bought Roku are going to have bought here. What else? DraftKings runs up, no sell rules, all gone. Anybody see a theme here? FNKO. These are all stocks that I traded and owned. Now, I didn't own them great. I didn't trade them great. But the nice thing is I'm not in them now. So Funko breaking out of this space. And these are monthly charts. See if we can see that in the weekly. Yeah, I see Funko broke out there. And, honestly, I probably sold it here. And, and then it doubles from where I sold it. But I'm not in it for this, and I'm not in it for this. If you happen to get in it, that's why we have the 7% stop loss rule. Protect you. If you bought it here, gaps down here, okay, I made a mistake. It happens. They can't all go up. I get out. Whatever price it is, if it gaps, I get out. And guess what? Sometimes they come back and go higher. That's fine. This is insurance policy on this happening. A stop loss on a single stock is like an insurance policy on your whole portfolio. It's designed to protect you from a catastrophic loss on the whole portfolio. If you have 10% of your portfolio in Funko and it goes down 50%, your whole portfolio goes down 5%. Let's say you had Twilio, your whole portfolio goes down another 5. Let's say you had Team, and your whole portfolio goes down another 5. So in 3 names, you give back 15% of your performance. That's if you're lucky to be up for that. So that's what it's designed for. That's what the sell rules are for. And the problem with sell rules is they're not always going to work perfectly. So if we go to Team, that looks like a sell to me. That might have got me out, intra-week. But now they're just piling on. Look at all these sell rules here. Look at all, I mean, it's just week after week to the downside. Honestly, I just don't see any reason for an individual investor to have been in this stock. So hopefully none of you were. Net, another one that got hit really hard today. So there were some landmines today, which is why I was a little bit confused with the market overall. Snow, in sympathy with the others. They didn't report earnings, but in sympathy with the others. And so of the big caps, let's look at Tesla. Tesla is holding up the best. I think if Tesla finally breaks, then that'll be the last one to go, and then maybe the bear market can be over, because it's held up the best of all of them. But it's down 50% off its highs, so that's not very comforting for most people if you're still holding on. Google down 42%. So you have to have sell rules. I don't know what else to say to emphasize that. And one thing about selling, let's say I know there's some people that maybe you think if you bought Google here or here or here and you want to hold it forever, that's the dream. That's fine. Great. I think that's fine. But maybe you probably should be reducing, because the math is cruel, and then the money will really affect you. So, if you put 10,000 into Google here, let's say it turned into 1 million, and I'm that's just to make the math easy on me. So you turn 10,000 into 1 million by holding, and holding, but now you've got, what's it down, 40%? Now you got 600,000. So you're down 400,000 off the highs, and you only put $10,000 into it. You see how that number is really difficult psychologically. I can't. I don't know. I wish I could, but I've never been able to overcome it in that type of size. So, if you put 10,000 here and it becomes 20, maybe you take 5 out, and it becomes 50, you take another 5 out, and it becomes 90, you take 30 out, and it becomes 180, you take 30 out, and then now it becomes 200, you take 100 out, and you take a bite of the apple all the way up. You don't have to eat the whole apple, but you take a bite of it each step of the way. I think that would be much easier to handle psychologically and much more realistic to do versus, putting 100 grand in here and running it up to 10 million. And, that's, I could have done that. And, in theory, I could have done that. But in actuality and reality, I have to admit that I would not have been able to handle the wiggles along the way with that much size. So that's something to think about from a sell standpoint. What else? So, are there any other stocks that I wanted to talk about? I think I covered them mostly. Apple and Microsoft, Tesla, you guys can pull them all up. I would review them, and you can see a lot more pink than blue. Look at all the blue here with Microsoft on the way up. And then now it's just nothing but pink. It's under distribution. Little things that jump out at you when you review these things after the fact, for sure. But the next time, the next cycle, you won't get caught like that. All right, let's do the quote of the week. It's from Market Wizards, Michael Marcus. And being a successful trader takes courage to try, the courage to fail, the courage to succeed, and the courage to keep on going when the going gets tough. And the reason I like this one is the going has gotten tough. It's been a very difficult market. It's a lot of back and forth by that S&P chart I showed you, and the ups and downs. And, I do hear people, they'll call in or email and say, the market's tough, cancel my subscription. And I just think that's the wrong approach. But I get it. I've been there. It's not easy for sure. But if those of you that are going to survive this period, when it finally comes out, I think you're gonna reap the rewards. And it's a very difficult game to turn off and on. So you have to stay engaged. I'm not saying you have to be actively trading all the time, but if you play golf, it's like golf. You got to be out there hitting balls every once in a while at a bare minimum to keep that feel, to keep that swing going. And then there are periods where you're really practicing hard and playing a lot. And then you can get, turn it down a notch or two, but you never get fully away from it. That's how you can be a success at this or anything, any other sport or hobby like that, is, just staying engaged like that. It's why Bill never stepped away from the market, hardly ever. Scott O'Neill said as a kid, he remembers they had a cabin in Oregon. And, remember, this is probably the early 80s, no internet, nothing like that. And they'd go up to this cabin. It was kind of isolated. And Bill would bring all his red maroon books with him, to look at charts. And he'd say, they're planning to be there for a week or two. And invariably after 3 or 4 days, Bill would get antsy, didn't like to be away from the market, and would come home and And you know, now Bill is, I don't know if extreme is the right word, but his commitment to this is legendary and higher than most of us, including me for sure. But that doesn't mean you can't be just a notch below where he is, and in that type of commitment to it, if you want to be successful at this. So it takes courage. You have to try. You have to keep trying. You're going to fail, and just get back on that horse and try again. Okay, I know this is probably a long video. I apologize. I thought it would be long because I'd been gone for 2 weeks, and in fact, I pulled a couple of screenshots that I wanted to talk about. Some maybe I'll show them next week because I was worried about the length of the video. Here's our contact information: marcusmith@investors.com, 800-424-9033. Have a great weekend, everybody. We'll talk to you soon. Bye-bye.